A very warm welcome to all of you here. In this video, we are going to start with another chapter of class 12. The chapter name is Company's Balance Sheet. In this, we need to prepare the balance sheet of companies, the joint stock companies we are talking about, not of partnership firms or sole proprietorship businesses. Here, we need to prepare the balance sheet of companies in a particular format. And that format is prescribed in the Schedule 6 of Companies Act 2013. Earlier it was 1956. Now it is the Companies Act, the revised one is 2013. Now in this chapter, many of the students say that it's a very drab, boring chapter. But actually it's not. Or maybe we'll try to find it, find out ways to make it not so boring. Okay. Basically, this chapter will take you back to your childhood, maybe when you used to do some jigsaw puzzles. You understand jigsaw puzzles? Tidbits of a bigger picture and then you put them in proper place and your picture is ready and complete. Okay. So something like that we are going to do in this chapter. You will be given certain assets and liabilities and information. You will have to find the appropriate place for them and put them in their places. That's it. It's that simple and interesting. In that, you need to have a good sense of logic also as to why a particular item is an asset or a liability. You need to be clearly, understanding what is an asset and what is a liability. And of course, the different forms of assets and liabilities. Which are for the long term, which are for the short term, okay? Which are your internal liabilities, which are your external liabilities. Right? So here we need to develop a logic and that is very simple. If you discuss a few things, all of it will be clear. Now, coming to the format. All this while we were doing sole proprietorship and partnership business, the final accounts of those, in which the balance sheet used to be presented in a horizontal manner. Horizontal meaning liabilities and assets side by side, like in account format, the T format, yes, and the totals here on the either side. Now we are not going to do this. Company accounts does not follow the horizontal balance sheet. It prescribes the vertical form of balance sheet, wherein we have liabilities first and then the assets. The liabilities total and the asset total here. So basically it remains the same, just the format and the positioning remains, will change a bit. Okay. Now in my next slide I have made some diagrams here to make you understand the basic format of the balance sheet. Once that's done, we'll come back to some explanations of some new things or new fundamentals which need a bit of description and detailing. Alright? So go have a look at the format and come back. Alright, so we quickly take a look at how my balance sheet looks like. Now this is only the equities and liabilities side that I have shown here in this slide. Now you can see that this is just vertically one below the other. Alright, now the heading goes as balance sheet of so and so company limited. Here I've named it as Gravity Limited, as at 31st March, and the given year you will fill up there. So that is your heading on top. Then you will have a particulars, note number column and the amount column. So this side we have equity and liabilities. Now equity again meaning the capital part of it, right? The owner's funds, shareholders' funds, those things, right? And then we have the other liabilities, meaning the outside liabilities also. So let us take up quickly each item here. So here first thing you head it as equity and liabilities. There are four important subparts here, main four headings. Number 1, shareholders funds. Number 2, share application money pending allotment. Number 3, non-current liabilities. And 4th is current liabilities. Now, shareholders funds is further broken up as share capital, in which we will have equity share capital, preference share capital, everything there. Reserves and surplus. Now any reserve or surplus, that is those funds which are created or set aside by accumulating profits each year. Okay, be it capital profit, revenue profit, any type of surplus, any type of reserve is mentioned under this heading. Okay, we can have examples like general reserve, capital reserve, securities premium reserve, or any fund, reserve fund, all those mentioned there under reserves and surplus. This is also, a part of shareholders funds because this is created out of profits. Point number 3 is money received against share warrants. This I will explain separately. Point number 2 is share application money pending allotment. Now this again refers to that part of share issues where we have the company issues share for subscription. People are interested in buying, so they will also pay some money along with their application to purchase shares. But this application money needs to be adjusted against allotment, meaning when a particular shareholder has paid some money for application, meaning for buying the share, showing his interest in buying the shares of the company, he might not be allotted the entire number of shares he has applied for. Maybe he has applied for 50 shares, but he's allotted only 30 shares. So this application money by default does not become shareholders' funds immediately. It has to be adjusted first, and only after allotment that can I add it to the share capital. This part of it will be dealt further in detail in the chapter issue of shares. For now, you need to know the amounts marked with asterisks marked there. As you can see, money received against share warrants or share application money pending allotment written there. These items needs to be just you have to understand the meaning, and you have to know where it is supposed to be placed in the balance sheet. That's it. No accounting treatment is required for such items which are marked with the asterisks there. So share application money pending allotment, meaning you have received it from your prospective shareholders and you are still to allot them shares. So that will be put under point number 2. That is also a main heading there. Point 3 is non-current liabilities. Now there is a distinction between current liabilities and non-current liabilities depending on the time period. So now how do we distinguish whether a liability is a non-current liability or a current liability? It depends not only on whether it is payable within 12 months or not, as you've been doing till now. There is one more angle to it. One more consideration, that is the operating cycle of the company. So that operating cycle also I will explain in this same video, but a bit later. But if you know that a particular liability is a non-current liability, you know where it has to be placed. Non-current liabilities has 4 subheadings. Long-term borrowings such as debentures, bank loans, term loans you have taken from other sources. Deferred tax liability. Now this is a liability which is supposed to be paid in the next year or years. A further detailed explanation will be attached herein in this video itself. Other long-term liabilities which are not included in point number A, B or D, and long-term provisions. Long-term provisions meaning you know for sure that this certain amount I have to pay in the future. Maybe sums related to, you can say, employees provident funds and gratuity and all those things. So these are provisions you have created for long-term payment. This will be under long-term provisions. Point number 4 is current liabilities. These are short-term liabilities which need to be paid in the immediate future. So this also has 4 subheadings. Short-term borrowings, meaning borrowing from, say, the bank for a month, a period of 3 months, 6 months, 8 months, maybe something like that. Bank overdraft is one item which will be under short-term borrowings. Trade payables. Now trade payables is a new term for you. Trade payables means it includes creditors, trade creditors, people whom we have to pay for, our purchases and all those supplies. And also it includes bills payables. This concept you have already done in your class level. Okay, so those 2 things taken together is termed as trade payables. Other current liabilities. Meaning, say for example, outstanding expenses that you are supposed to pay, or you've taken advances from your customers. So these are other current liabilities. Miscellaneous ones will be put under here. And short-term provisions, example here will be a provision for tax, meaning payment that you need to make in the immediate future. You have kept aside certain amount for that, and that you have termed as short-term provisions. Alright, so this is how your equity and liability side of the balance sheet looks. Now we will move on to the asset side of the balance sheet. Okay, in continuation to the liability side itself, after we have totaled up the liability side, we start with the assets. Earlier in class 11, you were doing the horizontal form of balance sheet. Now it is vertical, right? So just below the liabilities, we start with the assets. Asset side has two main subheadings, which are non-current assets and current assets, 1 and 2. Of course, it has other subheadings. Non-current assets meaning assets which we'll use for a longer period of time, usually more than 1 year. Under that, we have fixed assets, and you are already familiar with terms like tangible and intangible fixed assets. Tangible like land and building, furniture, fixtures, motor vehicles, etc. And intangible would be goodwill, copyright, patents, trademarks, etc. or computer software, something like that. Two additional figures are given here. Capital work in progress. Work in progress meaning something it is still going on. The work is not finished. Capital work in progress, I can give you one example, would be like a building under construction. It's a big building which will ultimately turn into a fixed asset, right? And the work is still going on. So whatever value or whatever costs or expenses we have incurred till now to make the the building, we will add up and we will show it up here. Capital work in progress, meaning fixed assets being developed. A similar thing is here with intangible assets under development. When the company is trying to build up on a patent or something like that, maybe research and development, etc. So here it is spending on a development of an intangible asset, which will eventually become an intangible asset. It's still not finished. So that will be shown under this point subpart 4. Coming to other non-current assets are non-current investments. It can be trade investment, non-trade investment, whatever. But if it is for a longer period of time, we put it under non-current investments. This can be investments in shares and debentures of other companies, bank, fixed deposits, etc. So you have made investments in any other place, it comes here. Deferred tax assets, as we have discussed the deferred tax liabilities. Now this is an advantage on terms of tax that I will be able to reap in the future. This also I will explain a bit separately. Long-term loans and advances. Now loans immediately you've connected to liabilities, but why is it given in the asset side? It is because these long-term loans and advances are advances you have given to others, and of course those are assets to you. Suppose you have made advance payment for purchase of fixed assets. So that is an advance payment, and that's not for a short-term thing, not for a purchase of goods. So that will be under long-term advances. Other non-current assets, if at all anything is given which is for a long period of time, doesn't fit into any of the other given headings, it will come under other non-current assets. Current assets has 6 divisions. Current investments. Okay, you have purchased short-term investments like commercial papers and all those things. So you have, these are like marketable securities. You can quickly, sell it off and convert it into cash. So those will come under current assets. Then you have inventories. Inventories meaning stocks. Okay, stocks, spare parts, loose tools, whatever is there for you for, on a running basis, you can convert it into cash. And you are holding it for a short period of time, those will be inventories. Okay, this will include stocks of finished goods, raw materials, work in progress of products and all. Those will be here. Trade receivables. Trade payables, trade receivables, right? Receivables is something that you will receive, so it's an asset. These include trade debtors, people who will pay you money for goods that they have purchased on credit, bills payables, etc. These two things will be clubbed and merged under trade receivables. Then you have cash and bank balances. Needless to explain this, okay? And short-term loans and advances. These are short-term advances and loans that you've given to other people. And other current assets, which are miscellaneous things like, say, prepaid expenses or, something, an income that you have earned but not received. So those things will be clubbed under other current assets. And then we total up the asset side. So this is how your asset side looks like. Okay, so now you have seen the format of the balance sheet, the liability side and the asset side. There I had told I will explain a few things a little more in detail with some writing so that it is clear, the concepts here. Mostly these are those items which are marked with the asterisk mark, and you will not be asked the accounting treatment for it, but you should know what this item means and where it is supposed to be shown. Correct? So first thing we start with money received against share warrants. Now shares, you have this, heard this term before, but share warrant means what? Now, if you want to purchase the shares of a company, you will have to pay a certain amount and the company will allot you shares. But if the company is not selling the shares right now, it will sell the shares in some future. You can do some advance booking kind of a thing and purchase share warrants. Now share warrants are certificates issued by the company only, which will give you the right to purchase the shares of that particular company at a certain date in future, whenever it issues the shares, and at a certain price, fixed price. Because you are expecting that when the company will issue, it will issue at a higher price. So why not just book it for a lower price? So share warrant gives the shareholders, the future shareholders, the right to purchase certain number of shares at a certain date and at a certain price later on. Okay. Now this is also shown under shareholders' funds, because sooner or later this amount that we have received, as the company has received, will become a part of the share capital. Correct? So that is money received against share warrants. Next we come to the operating cycle, which is a pretty interesting thing. Now you must be thinking, all this while we knew that current liabilities are those liabilities which need to be paid within 1 year, and non-current liabilities, meaning the long-term liabilities, are those which need to be paid after 12 months, 1 year. But there is one more aspect to it, that is the operating cycle. Every business will have a different operating cycle depending on the nature of the business. A huge manufacturing or shipbuilding company, for example, will take a lot of time to start from the raw material and bring it to the finished product stage. Whereas small consumer goods or daily use products off the shelf, suppose you are talking about some chips or biscuits or something, the processing time is very less, right? So it all depends on what kind of business we are talking about, and operating cycle will be bigger or smaller depending on that. So basically, what is an operating cycle? The business will have certain cash with which it will purchase the raw material required for making the products. It will purchase it, and the stock of raw material will stay there for some time before it starts or moves into the processing process, right? In the process of manufacturing. Now here, this will be, suppose, say 3 months. It will take 3 months to get started with the manufacturing process. Then the processing will take some time. Maybe it takes around 5 months. 5 months it is required to convert the raw material into finished goods. So that time is also there, gestation period. Then once the goods are ready, you will have to keep it in stock. It's not that today it's ready and I sell it today itself. I'll have to hold the stock for some time. Maybe I'll stock it up for 2 months. And then I'm able to sell it. But again, do I immediately get cash? No, not every sale is a cash sale. I also make credit sale. So this gets converted into trade receivables. Trade receivables meaning debtors and bills receivables, right? So here I am selling on credit. Maybe I allow my debtors a period of 3 months to pay me. So this person also, my cash is getting stuck here, right? for 3 months. Then after 3 months the trade receivables pay me, and so I get back my cash. This is where I started. So it's a continuous thing, and that's why it's called a cycle, right? So you come back to the starting point. So this entire time, how much did I take to start from here and complete one full cycle? 3 months, 5 months, 8 months plus 2 months, 10 months and 13 months. So my operating cycle here is of 13 months. More than 1 year, right? So here we will have to find out a way to classify the liabilities or even assets for that matter as current or non-current. Clear? So if a liability is to be paid within 12 months or within the operating cycle, it will be classified as a current liability. Okay? But if it is supposed to be paid beyond 12 months or beyond the operating cycle, then it will be a non-current liability. Okay? I have taken a small example here. Classify the following into current liability or non-current liability. Okay? And these sets will help you classify them very easily, to visualize it basically. This is the operating cycle, which can be less than 12 months also. A company can have an operating cycle of 8 months maybe. Okay? So 12 months here, and this is the year. Now, if any liability is within this circle or within this circle, meaning the outer circle, within the outer circle, it will be classified as a current liability. If it is beyond this outer circle, it will be a non-current liability. Same thing here. The operating cycle is more than the 12-month period, 1 year. So if a liability is here or here, meaning within the outer circle, it will be current liability. If it is beyond the outer circle, it will be a non-current liability. Example, a creditor liability. Operating cycle is given as 10 months. Okay, this is it, months. So 10 months is the operating cycle. So we are where? Here or here? Yeah, here in this one. Okay, where operating cycle is less than 12 months. The expected period of payment is 8 months. Meaning you need to make the payment after 8 months. So what will you classify it as? A current liability or a non-current liability? 8 months meaning it is within this circle. So it is definitely a current liability. Correct? Okay. Now we take the second case, a bill payable. Operating cycle is 10 months. Again we are here. And the expected period is 15 months, the payment. I need to make the payment after 15 months. So I'm not even here, I'm not even inside here, I'm rather outside here. This is beyond 12 months, right? So this I will classify as a non-current liability. Very good. Clear how we are doing it? One more. Expense due. So this operating cycle is given as 18, of course, beyond 12 months. So we are doing this case. Expected period of payment is 24 months. Even beyond this, 12 months, 18 months, 24 months and year. So again, it's a non-current liability. Correct? So here, you need to understand very clearly, you need to take both the parameters into consideration before classifying it as a current liability or a non-current liability. Okay? Sometimes, some have also come in the board paper, if you refer the previous year figures, questions. So this, I hope, is clear. Point number 3 is deferred tax liability or asset. Yes, so liabilities was on the equity or liability side and deferred tax asset was on the asset side. Now what is deferred? Deferred meaning, yes, postponed to or which will carry forward in the next years. Yes, so that is meaning of deferred. Now clearly understand that the company follows certain accounting standards and as per that it finds out the accounting profit each year. But the income tax department will have a different way of calculating the tax. Okay. So here you will have to see that the taxable income and accounting income, whichever is more, that will determine whether I have eventually a tax liability or a asset, a deferred tax asset. Understand using an example. Suppose the tax rate is 20%. Accounting income, meaning accounting income profit as per the business, the company, it's coming to 1 lakh. But the income tax department tells you that the taxable income is only 90,000. It's not 1 lakh. Some income that you have taken this year actually belongs to the next year. So we will calculate that in the income of next year. Okay, difference? Right? So now how do we reconcile? That 10,000, of course, on that I will not have to pay tax this year. Okay? So my tax liability comes to 20% of this as per me, that is the company, and as per the income tax department, it's 20% of 90,000, that is 18,000. So 2,000 less tax I am paying. As per me, I am supposed to pay 20. As per the income tax department, they are asking me to pay only 18. But do you think this 2,000 I don't have to pay at all? No. This year I am not paying. I will have to pay this the next year when the income tax department will count that 10,000 income year. In that year. Clear? So this tax is accumulated and this is deferred to the next year. So something I know that I have to pay next year is a liability, right? So this results into a deferred tax liability of 2,000. That I will show in the balance sheet. Clear? And if the case is vice versa, accounting income is less than the taxable income, I will have a deferred tax asset here. So it all depends on which is more. If accounting income is more than the taxable income, it's a deferred tax liability, and if the accounting income is less than the taxable income, it's a deferred tax asset. Okay? So here you will have to just understand what is the meaning of this and where it is supposed to be placed. That's it. Fine. So I hope all of this here is absolutely clear to you. Right? So one more important thing we need to do is discuss contingent liability and commitments. Okay. So contingent liability and commitments. This is something that you would not have found in the format of the balance sheet. Because these are certain things which are not actual or real liabilities as on this date, meaning on the date of balance sheet. So therefore no entry has been passed yet for these kind of liabilities, okay? But why do we mention this here then? What is this? First thing you need to understand that what is the meaning of a contingent liability. Contingent meaning a liability which might arise later on, a future date. And it depends on the happening of a certain event. If this will happen, I will have to pay this. So the liability arises itself only after that future event takes place and you don't know whether it will happen or it will not happen. Therefore, there is uncertainty. Of course, since there is no certainty about it, how can we pass the entry for that? Yet, following the concept of full disclosure, we do have to show that, okay, this is a probable liability that might happen in the future. So, ho sakta hai kind of, right? So, here, one example is proposed dividend of a contingent liability. Proposed dividend meaning the company has proposed to the shareholder that, okay, we are going to give you so much dividend, meaning returns on your investment. Now, a company is promising. So why is it not an actual liability? Because it depends on the shareholders. Once the shareholders sit for the meeting, approve it, okay fine, we accept this much as the return, then only it becomes a liability for the company. Okay? Therefore, proposed dividend on the closing date is not an actual liability. Only after it is approved by the shareholders does it become an actual liability. Same happens with bill receivable discounted with the bank. Bill receivable concept comes from your class 11 knowledge. You know, if you discounted the bill with the bank, the bill has gone to the bank has financed you. Now what will the bank do? The bank will present the bill on the due date to your debtor. What happens on that date? If the debtor honors the bill, you don't have to do anything. Fine. The bank has got its payment from the debtor. But what if the debtor does not pay, makes a default in the payment of the bill? The bank will take it from you because you have got it financed with the bank, right? So therefore, it all depends on what your debtor does on the due date. So the main hero of the movie is your debtor. So it all depends on what he does, right? Not on you. Therefore, if you have discounted a bill with the bank, there's a question mark. Payment karega ya nahi karega? Correct? So that is why it's a contingent liability. It might arise, it might not arise. But again, these are like uncertain. We don't know whether it will happen or not. But commitments are a bit different. Commitments meaning you have given your word. I will do this. Right? That means you have to do it. It depends on whom? Me. Uncalled liability on shares or other investments partly paid. Meaning, suppose you have invested in some other company. You have purchased shares. Suppose the nominal value of those shares was rupees 100. Meaning, you will have to pay 100 rupees to purchase one share of that company. Alright? But since the shares can be divided into installments, that company has asked you to pay only 60 rupees till now. So you have paid 60 rupees. Fine. You paid 60 for something which is worth 100. Do you think you don't have to pay that 40? You will have to. But only when the company will call for it. But you clearly know that this 40 is a pertinent, a particular liability for you. A short. You have to pay this. Of course, the date is still not arrived. Right? Therefore, it comes under commitment. Meaning 40 rupees, the unpaid amount that you will need to pay is your potential liability. Correct? So this is shown, the contingent liabilities and commitments are shown as a notes to account, meaning an explanation to the balance sheet figures. Apart from other notes to accounts that will be made as an explanation, you will also have to show this under notes to accounts here. It doesn't come as a part of the balance sheet, right? Okay? So I hope all the explanations are clear. Now we will quickly take a very fast exercise and we will do the jigsaw puzzle. So this is your jigsaw puzzle. These are the pieces given to you. Okay? Some assets, some liabilities, all mixed up. Now you need to assort it, and this is the structure I have given you, which is of your balance sheet, equities and liabilities. I have just mentioned the important points here. Okay, so wait. And number 4. So these are the main headings here. 1, 2, 3, 4, and these are the asset side 1 and 2. This is the main structure, right? Now we will have to pick up amounts from here and place it there. That is what you need to do. Then let's see. Goodwill. What is it? Asset or liability? Asset. Very good. So it comes this side. Current, non-current. Non-current is long-term and it's an intangible asset. Remember that there are various breakers. You need to learn the entire format. Okay. So I know that it will be coming here, somewhere here. So let us put goodwill as 33,000 here on the asset side. And it's something rough that I am doing. Okay. Bank overdraft 5,000. Liability or asset? Liability. Non-current, current. Current. It's a short-term borrowing. So here we have bank overdraft as 5,000. Okay. Then we have equity share capital. Equity share capital 1 lakh. Share capital, shareholders funds. So here we have equity share capital as 1 lakh. Land and building, asset, a fixed tangible asset. So it will come here, and land and building is worth 80,000. Share application money pending allotment. This is one of the headings here. The second one. Share application money pending allotment. So it goes straight there. Then deferred tax assets. Asset. There is no confusion about it. And it's non-current one. So it's coming here, which was 4,000. Alright, so this is what we're doing. We just need to know this structure and where each item will come. And this sum is so easy, this chapter is so easy. Then 10% debentures, 50,000, assets or liability. Liability and a long term one. So here 10% debentures. They are worth 50,000. Good. Trade debtors. Debtors are part of trade receivables. Trade receivables, assets, current assets. Okay. So here we have trade debtors. Trade debtors are 30,000. Great. Okay. Prepaid expenses. Prepaid expense. Expense you pay in advance. It's an asset. Of course, a current asset. So prepaid expenses will come here somewhere 20,000. Okay. Then we have securities premium reserve. A reserve is the type of reserve. It's a capital profit to you. So this comes under reserves and surplus under shareholders funds. So this 10,000 comes here. Securities premium reserve. So basically you need to know this in a rough thing, and then you will total it up and find out, and the total is coming to say this. Of course the assets and liabilities should match. Right? So this is what basically is the gist of what you're supposed to do. Of course we'll do a bit of fine tuning to it, because we need to know exactly the subheadings and headings under which they're supposed to come. Okay? So that will happen in due course of practice, but this is what is you're supposed to know about this chapter. So I hope this chapter wasn't as boring as people usually talk about this chapter, and you will be able to do this just like that. So please do subscribe to my channel if you like my videos, and please like my channel, and you can also leave a comment or a suggestion for me. Thank you so much.